Hello everyone, I'm from the Bodhi Academy. So today we'll be starting with the accounts paper that is of 2018. So let's start with the paper discussion. Okay, so quickly let's start with the discussion of the Goa Board 2018 accounts paper. So the first question is, partners' current accounts are prepared when capital accounts are, okay, so this, with regards to this partners current account, the question is when we prepare partners current accounts, when the capital accounts are, the first is fixed. Okay, so the first answer is when the capital accounts are fixed. Okay, then the second question, on dissolution of partnership firm, payment of unrecorded liability is. So now we all know that when in dissolution, what we do is we prepare realization account. So the question is, on dissolution of a partnership firm, payment of unrecorded liability is done on which side? Okay, so payment of unrecorded liability is debited to realization account. Okay, now see. So we prepare the format like this: particulars amount, wherein we take all the asset and liabilities, and here we take unrecorded liabilities, unrecorded liabilities, and on this side we take unrecorded asset. Okay, on credit side. So this answer of this is debited to realization account. So unrecorded asset we debit to realization account. Okay, so the second answer is debited to realization account. Okay, now third question, which of the following items are credited to partners capital account? Now with regards to partners capital account, which of the items, when we prepare a partners capital account, these accounts are credited, such as interest on capital, okay, then interest on this partner's salary, then share in profits. Okay, so which of the following items, these are the items that are credited to partners capital account. So the third one, third answer is interest on capital, partner's salary, then partner's commission and sharing profits. Partner's commission and sharing profits. So these are the items that we credit to partners capital account. Okay, so interest on capital, partner's salary, then this partner's commission, sharing profits, partner's commission. Then the next question is, Deepa and Seema are partners sharing profit in the ratio of 3:2. So question number 4, Deepa and Seema, these are partners and they are sharing the ratio of 3:2. Then the next is, Sushma is admitted as a partner. The new profit sharing ratio between them is 5:3:2. So here one more partner is added, Deepa Seema and Sushma, and their new profit sharing ratio is 5:3:2. So what is the question? They told us to find that sacrifice ratio. So whenever we find the sacrifice ratio, you have to put this formula, that is old ratio minus new ratio. So sacrifice ratio is equal to old ratio minus new ratio. So what is the old ratio now? So we have to find out of Deepa and Seema. So Deepa's old ratio is 3:2, which means is equal to 5, and this is 10. So old ratio of Deepa is 3 divided by 5 minus new ratio of Deepa 5 divided by 10. So we have to make the denominator same of both Deepa and Seema. Similarly, we write the old ratio and new ratio of Seema. So old ratio of Seema is 2/5 minus new ratio of Seema is 3/10. So now this will come to we'll have to do the cross multiplication. Then this is 30 minus 25, which will give us 5/50. Then next 50, then this will give us 10 multiplied by 2 will give us 20 minus 15, which will give us 5/50. So the sacrifice ratio of both the partner is 1:1. Okay, so this is your question number 4. Then next question. Tina and Sarah are partners in a firm sharing profit and losses in the ratio of 7:5. Their capitals were 8 lakh and 6 lakh respectively on 1st April 2016. Now here you have to see what they have told us to prepare. So they told us to prepare profit and loss appropriation account for the year ended 31st March 2017. So here already I have prepared profit and loss appropriation account. So we have to write down for the year ended 31st March 2017. Then the first thing what they have given is their capitals were 8 lakh and 6 lakh. So of course we have to find out interest on capital. So interest on partners capital they have given as 12% per annum. So interest on capital, that is 8 lakh multiplied by 12%, which will give us 96,000 for the first one, Tina. So 2 interest on partners capital, so interest on partners capital, first one Tina and Sarah. So Tina's interest on partners capital we got it as 96,000. Then Sarah's interest they have given as 6 lakh. So 6 lakh multiplied by 12%. So 6 lakh multiplied by 12%, which will give us 72,000. So the total of both the things, which comes to 1,68,000, we have to take it on the outer column. Okay, so interest on capital is done. Now we'll move to the next. The partnership deed provided for the following: interest on drawings also they have given at 9% per annum. And with regards to interest on drawing, they have mentioned that the drawings of Tina and Sarah during the year they have given were 40,000 and 60,000 respectively. Okay, so how much was the drawings of Tina and Sarah? Were 40,000 and 60,000. Okay, so now interest on drawings. So by interest on drawings, of both the partner Tina and Sarah. So Tina's is how much? Tina they have given as 40,000 and okay, so how will calculate 40,000 multiplied by what interest they have given on drawings? 9%. So it's 9 divided by 100 multiplied by during the year they have given. So when they say, when the question says during the year, you have to take 6 upon 12. So the answer will be 40,000 multiplied by 9 divided by 100 into 6 divided by 12, 1800 for Tina. Similarly, you have to find it for Sarah. 60,000 multiplied by 9 divided by 100 into 6 divided by 12, which will give you 2 divided by 100 into 6 divided by 2, 2,700. So we got the interest on drawings as 1,800 for Tina and 2,700 for Sarah. So which the total of both the things comes to 4,500. Okay, now next, salary to Tina they have given as 5,000 per month. So 5,000 per month in the sense what you are going to do, 5,000 multiplied by 12 months. Okay, so here you have to write down salary to Tina, it's 60,000. 5,000 multiplied by 12, you got 60,000. Next, what they have given, so only this information they have provided, and the next what they have given is the net profit as per the profit and loss account for the year ended 31st March 2017 was 4,45,000. So this is the overall net profit what they have given. So it is 4,45,000. So here you have to write down by net profit as 4,45,000. Then you have to balance both the side, and you have to find out how much is the profit that we are going to distribute among the partners. Profit and loss appropriation is nothing but you just are looking for how much will be the distribution of the profit or the losses among the partners. Okay, so now we'll add 4,45,000 plus 4,500, which will give us 4,49,500. Then this one, this side on debit side we are getting 168 plus 60,000, which will give 2,28,000. So 2,28,000 minus 4,49,500, which will give you 2,21,500. Now this 2,21,500 you have to distribute among the partners. So you have to write down as to partners capital account. Tina, and this ratio, this amount you are going to distribute in the ratio Tina and Sarah. So 2,21,500 multiplied by how much is the ratio which is given? 7:5. So 2,21,500 multiplied by 7 divided by 12, which will give you, so it's like this, 2,21,500 multiplied by the old ratio of partner is 7:5. This is for T and this is for Sarah. So 7 divided by 12, which will give you 1,29,208. Then again for Sarah also you have to distribute. So 2,21,500 multiplied by 5 divided by 12, which will give you multiplied by 5 divided by 12, which will give you 92,292. Okay, so this is what the profits which your partners are going to get: 129,208, then 92292. Okay, and the total of both the sides comes to 4,49,500. Okay, so this is how you have to solve profit and loss appropriation account. Then next is they have told us to prepare revaluation account, partners capital account, balance sheet of the new firm. So now question number 6. Neil and Vani are partners sharing profit and losses in the ratio of 3:2. So Neil and Vani's ratio is 3:1. Their balance sheet as on 31st March 2017 was as follows. So this is the balance sheet what they have given. So what you have to remember with regards to this is you have to see what kind of question it is, whether it is admission, retirement or death. So here they have mentioned it is admission. So on 1st April 2017, Shiny was admitted into the partnership for 1/5 share in profit of on the following terms. Then so they told us to prepare revaluation, partners capital and balance sheet. So whenever they tell us like this, then you have to prepare all the three accounts together. That is revaluation account, then partners capital account and the balance sheet of the firm. So we'll start with the old balance sheet first, and we have to see whether any adjustment are given for any of this liability or asset. Now first one is creditors. So just check whether any adjustment is there for creditors or not. So there is no adjustment for creditors, so I'll be taking this amount directly. So since it is a liability, it will go on the liability part. So creditors amount they have given as 67,000. Then next is bills payable. So again we have to check if there are any adjustment for bills payable. So I cannot see any adjustment with regards to bills payable. So bills payable 17,000 will come directly over here. Bills payable 17,000. Then the next, reserve fund. Reserve fund, what we do with regards to this is we distribute among the partners in their old ratio. So reserve fund here, where do we take reserve fund? We take it on partners capital account. We distribute among the partners, right? So now reserve fund they have given the amount as 30,000. So 30,000, since we distribute in the old ratio, I'll just do the working over here. So working note of question number 6. So reserve fund they have given the total amount as 30,000 and we have to distribute among the old partners, that is Neil. So I'm writing N and Vani V. Okay, so 30,000 into the old ratio of the partner is 3:1, so which comes to 4. So 3 divided by 4, 30,000 multiplied by 3 divided by 4, which comes to 22,500. Then again 30,000 multiplied by 1 divided by 4, which comes to 7,500. Okay, so this we have to write over here as by reserve fund. and okay, I'll write the name, Neil and Vani as of now, and then they admitted Shiny. Neil, Vani and Neil, Vani and Shiny. Okay. Next. Reserve fund we got of Neil is 22,500. Then we got of Vani as 7,500. Okay. Next. So next is capital account. So this is the old capital what they have given of the partner. Neil is 7,50,000. So these are the partners. This will go in partners capital account since these are the capital which are contributed by the partner. So Neil and Vani. Okay. So here when we write the partners, now see here what they have given the capital account on debit side. If they have given the capital account on credit side, then we would have taken capital over here. Now since they have given the capital on debit side, we have to take it on credit side. Okay, just opposite rule what you have to follow. So capital of Neil is 7,50,000. So I'm writing by balance brought down, by balance brought down, which is 7,50,000. Then Vani what they have given is 5,50,000. So I'm writing over here as 5,50,000. Okay. Then so only this information we have as of now. The next, cash at bank. So now whenever we prepare admission of a partner, we have to remember that we have to add whatever a new partner is bringing, the like capital and the goodwill. Okay, the share of goodwill you have to add it to the cash at bank. So I'm writing cash at bank at last in the asset part, because here for cash at bank we have to add the goodwill and the capital amount. So cash at bank, what is the actual amount of cash at bank is 86,000. I'm writing it in the inner column so that we can add it, and then we can add. There are more things over here, so then I'll take it on the outer column. Then bills receivable, we have to check whether any adjustment are there for bills receivable. So as of now there are no bills, no adjustment for bills receivable. So 12,000 I'm going to take it directly. So bills receivable, amount is 12,000. Then next, debtors, there are no adjustment for debtors, so debtors 32,000. Okay, next is stock 49,000. But there is an adjustment with regards to stock which is to be reduced by 10%. And do you remember for revaluation we take we see only the increase and decrease in the asset and the liability. Okay, so decrease in asset and increase in liability we check it on this side. Increase in asset and decrease in liability we check it on credit, we take it on credit side. So now here they have given that the actual amount of stock is 49,000 and it is reduced by 10%. So it means that it is reduced by how much? 49,000 multiplied by 10%, 4,900. Okay, so where this 4,900 you are going to take? Since it is reduced, it is a decrease in the decrease in asset, right? So we are going to write 4,900 over here to stock as 4,900. Okay, then side by side we, since the amount of the value amount of the stock is going down, we have to write stock less reduction, or we can write down discount. How much it is? 4,900 and the actual value of stock is 49,000. So which comes to 40 49,000 minus 4,900, which comes to 44,100. Okay. Then the next is furniture. Is there any adjustment for furniture? No, there are no adjustment for furniture. So directly we are going to write furniture as 35,000. So 35,000. Okay. Next, land and building. So land and building, here they have given the adjustment that building to be appreciated by 20,000. So appreciation in the sense the value of the asset is increasing by 20,000. So here we'll take the amount first on the asset side, land and building. The actual value of the land and building is 12 lakhs. And since the value is appreciating, we have to write add appreciation. It is appreciated by 20,000. Okay, so the total is 12 lakhs 20,000. Okay, now the appreciation value, where it is going to go, it will go on the credit side, because there is an increase in asset, no, so it will go on credit side as buy land and building. Only that amount you have to take which that has increased. Okay, increased by how much, that like this you have to say, by land and building, so it is 20,000. Okay. So the next is there being a claim against the firm for damages, a liability to the extent of 5,000 should be created. So 5,000 they have given as a claim for damages. So this claim for damages, since it is a adjustment, and adjustment has got two effects. Okay, so claim for damages is going to go on this side, to claim for damages. Which is 5,000. Then on 1st April 2017, Shiny was admitted into the partnership, right? So Shiny should bring 6,50,000 towards capital and 70,000 as a share of goodwill. So how we are going to do this? So first step is you have to this is a capital 6,50,000. So capital we are going to add capital, add it to the cash at bank 6,50,000. Then also the goodwill amount you have to add. And how much is the goodwill? What they have given, goodwill is 70,000. So the total comes is, so this is the first step. What you have to do, 86,000 plus 6,50,000 plus 70,000, which comes to 8,06,000. Okay, now the next is you have to, now you require in the balance sheet you will require capital, new capital of the partners. So here you have to find out how much is the capital, how much is the goodwill which is distributed by the partner. Okay, so by balance brought down we took it as 7,50,000. Then we also took reserve fund. Now goodwill we have to distribute among the partners. So goodwill amount is 70,000. So 70,000 goodwill distribution. Goodwill, what Shiny has brought is 70,000. So this 70,000 you have to distribute among the partners in their old ratio. Now what is the ratio? 3:1 of Neil and Vani. So 3 divided by 4 for N. So 70,000 multiplied by 3 divided by 4, which will give you 52,500. Then for Vani, 70,000 multiplied by 1 divided by 4, which will give you 17,500. So here I'm writing goodwill by goodwill as 52,500 and 17,500. Okay. Then the next, how much is the capital Shiny has brought? That also we have to write. So she brought how much capital? 6,50,000. So capital also you have to write down as by bank account. Shiny's capital is 6,50,000. Okay. Now the next step is you have to take the whatever the distribution you have made over here, that amount you have to take it over in the partners capital account. You have to find out whether it is a profit or a loss, and then you have to take the capital amounts. Okay, so the whatever the balancing figure you will get in partners capital account, that will be your capital figures. Okay, the new capitals. So now here we got land and building as 20,000. Yes, so 20,000. Then how much is this stock? And stock is 4,900. So I'll just add 4,900 plus 5,000, 9,900. So 20,000 minus 9,900. So which will give you 10,100. So this is your balancing figure after minusing your debit and credit side. So this 10,100 you have to distribute among both the partners. Okay, so and this amount, whatever the distribution amount you will get, you have to transfer it to the partners capital account. So to partners capital account, that is Neil and Vani. So partners capital account 10,100. So I'll do over here 10,100 multiplied by 3 divided by 4, which will give you 7,575 for Neil. And again you have to do it for Vani, right? So 10,100 multiplied by 1 divided by 4, which is going to give you 2,525. So this is how you have to take. So the total of both the sides should come to 20,000. Okay, this is how you have to solve the revaluation account. Understood? So then this amount, whatever the amount, amount you are getting after distributing the ratio of both the partners, you have to distribute this amount to the partners capital. Now from where you are going to transfer this amount? You are transferring it from revaluation account. So here you have to write down by revaluation. Okay, by revaluation, which comes to 7,575 for Neil and 2,525 for Vani. So everything we took now 7,50,000, then the capital balance, then reserve fund, we distributed goodwill also, then we took bank account, I mean the how much is the amount the capital brought in by the new partner, then we took the revaluation amount. Okay, from this revaluation account, that's why we wrote revaluation account over here. Now you have to total both the sides. My total comes to 8,32,575 for Neil, then 5,77,525, and here 6,50,000. Okay, now there's nothing on the debit side of partners capital account, so this only will be the capitals of both the partner. So to balance, close down, that is 8,32575 for Neil, then 577,525 for Vani, and for Shiny it's 6,50,000. Okay, so similarly your both the sides should tally. Then whatever the capital balances you got in partners capital account, that you have to transfer. So partners capital account, so these are the capital balances, right? So capital of Nail, Vani and Shiny. We all know that Shiny brought 6,50,000, so you can write down 6,50,000 over here. Then Vani's is we got over here as 5,77,525. So 5,77,525. Nail we got it as 8,32,575. Okay. Anything is left to take? I guess no, because everything we took over here while preparing the balance sheet. We took stock, furniture, land and building. Then we added this capital figures. Yes, that is capital and the goodwill. What we got 6,50,000, 70,000. So this is how you have to solve, and then you have to check whether your both the sides are getting tallied or not. So 8,32,575 plus 5,77,525 plus 6,50,000 plus 67,000 plus 17,000. And one more thing we are lacking, here we took claim for damages 5,000, we took it over here on revaluation account. So claim for damages, since it is the liability, it should also come over here, claim for damages, which comes to 5,000. So plus 5,000, which will give you 21,49,100. Here we took stock 4,400, then we took 35,000 as a furniture, then 12,20,000, then 12,000 as bills receivable, debtors as 32,000, then 8,06,000 is your cash at bank, then capital and goodwill, so which comes to 21,49,100. So this is how you have to solve the admission sum. Okay. Balance sheet of the new firm. Here you also have to write as on because she admitted on 1st April 2017. Then we'll move to the next question, or you will get either you'll get admission, retirement or death. Okay, so this is the question with regards to death of a partner. So Mickey, Vicky and Ricky were partners sharing profit and losses in the ratio of 5:3:2. I'll just prepare the revaluation account over here. So revaluation account, what they have told us to prepare, then partners capital and balance sheet of the new firm. So here what they have given, there are three partners, Mickey, Vicky, Ricky, were partners sharing profit and losses in the ratio of 5:3:2. On 31st December 2016, their balance sheet was as follows. So this is the old balance sheet what they have given. Then Vicky died on 1st May 2017, and it was agreed between his executors and the remaining partners that goodwill of the firm, here the goodwill of the firm they have given, then patents to be valued at 80, machinery should be reduced by 20, and premises to be appreciated by 80,000. Okay, then Vicky should be paid his share of profit till the date of his death. So based on the profit of 2016, so profit for 2016 was 1,50,000. So whenever they give such a adjustment, that you have to find out how much is the share of profit till the date of his death, it means that you have to find out profit and loss suspense account. Okay, profit and loss suspense account. So profit and loss suspense account, you have to find out first. So we'll start with the solution. I'll prepare revaluation account. Then partners capital account. So we'll take as particulars Mickey, Vicky and Ricky. And again particulars okay, and side by side I'll prepare balance sheet over here. Balance sheet of the new firm. Then what they have given is sundry creditors. So the first thing we have to check whether there are any adjustment for this creditors. So I cannot see any adjustment with regards to the sundry creditors. So creditors amount is 1,20,000. We are going to take the creditors amount as it is. Creditors 1,20,000. Then bank overdraft, any adjustment is given? No. So bank overdraft 60,000 as it is going to go. Bank overdraft 60,000. Then these are the capital accounts which we have to transfer it to partners capital account, PCA. Okay, partners capital account. So by balance brought down, as 3 lakh, 2 lakh 50 and 1 lakh 50. So 3 lakh, Okay, so by balance brought down, how much is the balance they have given? As 3 lakh, 2 lakh 50 and 1 lakh 50. And 1 lakh 50,000. Then we have to see, coming to the furniture side. Furniture, is there any adjustment they have given? No adjustment. So furniture amount we are going to take directly as 50,000. In asset. Then premises 2 lakh. Is there any adjustment? Premises, yes. So premises, what they have given is premises value to be appreciated by 80,000. So premises actual amount is 2 lakh. Add appreciation 80,000. So it will come to 2 lakh 80,000. Okay. Then next, patents. What they have told to with regards to patents to be valued at 80,000. So it means that we have to take patents over here. So patents to be valued at 80,000. So buy patents because there is an increase in the asset. Buy patents 80,000. Then machinery should be reduced by 20,000. So the actual amount of machinery is 3 lakh and they have told us that machinery to be reduced by 20,000. So to machinery, directly they have given the amount 20,000. Then also they have given patents to be valued, this we took 80,000. Machinery should be reduced by 20 and premises to be appreciated. So premises 20. Then anything else is left? No. So here we have to take 1 lakh, the total of we have to do. Then 1 lakh minus 20,000, so here comes 80,000. So this 80,000 you have to distribute among the old partner in their old ratio. So 80,000 multiplied by the ratio what they have given is of the partner is 5:3:2. So to partners capital account. Mickey, Vicky and Ricky. So 80,000 multiplied by 5 divided by 10, which gives us 40,000. So this 80,000 we distributed among the old partner. 80,000 multiplied by 5 divided by 10, which will give us 40. Then the next, with regards to Vicky, Vicky's ratio is 3. So 80,000 multiplied by 3 divided by 10, which will give us 24,000. So 24,000. So 80,000 multiplied by 3 divided by 10, 24,000. Then Vicky, 80,000 multiplied by 2 divided by 10, which will give us 16,000. So this is 16,000. Okay. So this revaluation amount, these are the profits, this is how they have distributed. So this we have to take on partners capital account. So as by revaluation account, and that amount, that is 40,000, you have to put under the respective partners head, 24,000 and 16,000. Okay. Next is goodwill of the firm is to be valued at 75,000. So 75,000 you have to distribute among the partners. That is 75,000 is the goodwill. So 75,000, and you have to take the share of the death partner. So how much is the share of the died partner? Now Vicky is dead. Okay, so the share of Vicky is 3. So 75,000 multiplied by 3 upon 10, which will give you 22,500. 3 divided by 10, which will give you 22,500. So this 22,500 you have to distribute among the old partners. Okay, whatever the remaining partners are there, no, in that in their ratio. Now the ratio will be how much? 5:2 of the new partners, the remaining partners. So 22,500 multiplied by 5 divided by 7, then 22,500 multiplied by 2 divided by 7. This is for Mickey, and this is for Ricky. Okay, so 22,500 multiplied by 5 divided by 7, which will give you 16,072, and this will give you 22,500 multiplied by 2 divided by 7, 6,429. Okay, so this amount we have to take in partners capital account, because here they are dividing the goodwill. So by Mickey's capital, how much is the Mickey's capital account we got in? Under this head we have to write down Vicky's head, 16071. Then by Ricky's capital, we got it as 6,429, and this, both the things you have to transfer on this side. So to Vicky's capital, as under this head, 16071 Mickey's head and 6,429. Okay, then one more thing is left with regards to adjustment, that is they told us to find out how much is the profit and loss suspense account. So whenever we find profit and loss suspense account, what do? We take the how much is the profit given here is 1,50,000 multiplied by the death partner ratio. Now what is the ratio over here? Is 3/10. Okay, 3/10 multiplied by the month. So how many months? He died on 1st May. Okay, and yeah, So 4 upon 12, which will give you 15,000. Okay, now here, this profit and loss suspense account by profit and loss suspense account, you have to write down on Vicky's side, because that is a Vicky's share of profit, no? Yeah. So now you have to balance both the side, and we already took the revaluation amount. Then Mickey's is 3 lakh plus 40,000, so 3 lakh 40,000. Then Vicky is 2 lakh 50 plus 24,000 plus 16,071 plus 6,429 plus 15,000, which is 3 lakh 11,500. And then with regards to Ricky, we are getting 1 lakh 50 and 16,000, so which comes to 16,000, 1 lakh 66,000. Which gives us 1,66,000. Okay, similarly here we have to find out, now this amount should be paid to the executor, because we are finding with regards to the death of a partner. So to executor's account, so death partner's executor should be paid whatever the profit is left of Vicky. So 3 lakh 40 minus 16071, which comes to 3 lakh 23,929 as two balance brought down. 3 lakh 23,929. Then Vicky's we have to pay it to the executor, and we will not take it to the new balance sheet. Okay, that whatever the balancing figure we are getting, we are not going to take to the new balance sheet. Okay, so here we'll get 3,11,500 only, because there is nothing is there on the debit side of Vicky. So here 3,11,500. Then Ricky's we are getting 1,59,571. So this is the total what we are getting. So the balancing figure what we are getting, we have to transfer it to the capital account, that is capitals in the balance sheet. Okay, Mickey we got 3,23,929. Ricky we got as 1,59,571. Then we took furniture, we took premises. Now what is left is the patents. Okay, machinery is left, and also we took with regards to patents, furniture, premises, then machinery is appreciated. Now the actual amount of machinery is 3 lakh. So, and how much it is appreciating, it is machinery should be reduced by 20,000 they have given, so less depreciation, so which will give us 3 lakh minus 2,80,000. Then patents actual amount is 60,000, and it is to be valued at 80,000, so only 80,000 we are going to take. Patents 80,000. Then stock amount they are given as 1 lakh, and no information is provided with regards to stock, so stock is 1 lakh. Then debtors 80,000. Debtors amount is 80,000, and cash at bank 90,000. Cash at bank 90,000. Then profit and loss suspense account, also we have to take it on the asset side. Which comes to 15,000. So the total of both the sides comes to 9,75,000, and this is the solution of your question number 6, that is death of a partner. Okay, moving next to the question of dissolution. Ria and Divya are partners sharing profit and losses in the ratio of 3:2. On 30th June 2017, their balance sheet was as follows. Okay. Now, balance sheet as on 30th June 2017. Creditors they have given. Now, Ria and Divya, these are two partners. And what they told us to prepare? Realization account, partners capital, and bank account. So Ria and Divya are two partners over here. Ria and Divya. Ria and Divya. Okay. What they have told us to prepare? Bank account. So here we'll write bank account and not cash account. Okay. Next, sundry creditors. Now whenever we are preparing this, we have to check how much are our asset and liabilities. Okay, so the first step is just check your all the asset as it is. You have to write down how many assets are given. So 2 assets on this side and buy liabilities on this side, on the credit side. So how many assets do we have in the sum? We have plant and machinery, we have furniture, stock, debtors, investment. Debtors we are going to take gross amount, and this PBDD is considered as a liability. Okay, provision for bad and doubtful debt is considered as a liability. So plant and machinery we got 4 lakh. Plant and machinery 4 lakh. Then we got furniture, then stock, debtors. Furniture is 50,000, stock 1,50,000, and debtors and investment. Okay, debtors 1,60,000, investments 90,000. So the total of this comes to 8,50,000. Okay. Next they have given. Next we have to check with regards to liabilities. How many liabilities are there? Creditors and what else? Creditors and loan. Rima's loan. Now Rima is a external liability, right? Since it is an external liability, we have to take it over here. If it was internal liability, then we would have taken it on cash or bank account. Okay, so now external liabilities and sundry creditors. So sundry creditors I am writing, and here Rima's loan will come. Rima's loan. So sundry creditors is how much? 1,10,000, and Rima's loan is 60,000. So 1,10,000 and 60,000, which comes to 1,70,000. Okay, then PBDD we have to show it separately because it is we are not considering it as a liability. So by PBDD, provision for bad and doubtful debt, as 10,000. Okay. Now, Now we have to move to the adjustment, and one more thing we have to take, we have to distribute general reserve 40,000 in their ratio. So general reserve is 40,000. You are going to distribute it in the partners capital account. So I am writing by general reserve. So general reserve they have given as how much? 40,000. So 40,000 multiplied by 40,000 multiplied by 3 divided by 5, which will give you 24,000. Then 40,000 multiplied by 2 divided by 5, which will give you 16,000. Okay, so this is your general reserve. This is for the this is for Riya and Divya. So Riya and Divya. Okay, so 24,000 and 16,000. Next thing we have to check the balance capital figures. So capital figures for Riya and Divya 4 lakh and 3 lakh. Okay, so by balance brought down 4 lakh and 3 lakh. Okay, then cash at bank is left from here. So cash at bank we are going to take in the cash or bank account. So here to balance brought down, how much is the cash at bank balance? It is 70,000. So 70,000 we are going to take it over here. 70,000. Then we have to come to the adjustment. Plant and machinery. On the above date, the partners decided to dissolve the firm, and the following was the result. Asset realized as follows. Plant and machinery, they sold it for 1,50,000. Furniture 80, investment 87,000, debtors 1,45,000. So like this we have to take the amounts over here. So since we took the asset on debit side, now we are selling it off, we are going to take on the credit side as the head by bank account. So by bank account, plant and machinery, furniture, then investment, debtors, stock. Okay, so plant and machinery 1,50,000, then furniture 80,000, investment 87,000, and debtors 1,45,000. Then Riya took over 50% of the stock at a discount of 20%, and the balance stock realized 30% more than the book value. So now working note will prepare with regards to dissolution. So dissolution working note. First, now what is the stock amount they have given? The actual stock is, how much is the actual stock? 1,50,000. Okay, so 1,50,000. So out of this 1,50,000, 50% of the stock at a discount. So Riya took the 50% of the stock. Okay, Riya partner, she took the 50% of that stock at a discount of 20%. So 50% of 1,50,000 which will come to 75,000. So 75,000. Now this 75,000, okay, which is the half of the stock which she took at a discount, but at a discount of 20% she took. So 75,000 multiplied by 20%, we are getting at 20%, so we 15,000, which we have to minus because discount is given. So 75 minus 15,000, which will give us 60,000. Okay, 60,000. Then what about the remaining stock? Now 75,000 is the remaining stock, right? So this stock, what they have mentioned is and the balance stock is this, whatever is left, realized at 30% more than the book value. So 30% more than the book value, in the sense this at 30%, but we have to add. Okay, so 75,000 multiplied by 30%, which comes to 22,500, but we have to add. So 75,000 plus 22,500, which will come 97,500. Okay, so now this 97,500 is realized. Okay, so here we are going to put only this 97,500 and not the stock whatever is taken by a partner. So whatever is taken by a partner, that we are going to show it separately. So 97,500 will come over here. Then so the total of this comes to 5,59,500. Okay, then how much is Ria took by Ria's account? She took stock now for how much? 60,000. So that we are going to, that we have already shown it over here, that the first stock she took at 20% discount and the balance remaining is realized. Okay, then the next adjustment, creditors were paid at a discount of 5%. Earlier creditors were 1,10,000, now we are paying creditors at a discount of 5%. So 1,10,000 multiplied by 5%, 5,500. So 1,10,000 minus 5,500, 1,04,500. So here we are going to write as to bank. We have to pay the liabilities also now. So creditors 1,04,500. Okay, 500. Then the next, Divya agreed to pay Rima's loan. Now Rima, who is an external partner, okay, who paid the Rima's loan? Divya paid the Rima's loan. So to Divya's account, your loan she is paying. So Divya's loan was Rima's loan was 60,000. So 60,000 is paid by Divya. So here Divya's capital account will come. Okay. Then the next is expenses of dissolution amounted to 5,000. So here to bank, dissolution expenses, which is amounted to 5,000. Okay. Now we have to tally and we have to check how much we are going to transfer it to partner's capital account. So here I am getting 1,019,500 here by partner's capital account. Whatever the balancing figure we are getting, Ria and Divya, is 1,32,000 and 88,000. Okay, so which comes to 2,20,000. So the total on both the sides will be 1,019,500. Okay, then this amount from the realization account we have to transfer it to partner's capital account. So here we are going to write as to realization account, that is 1,32,000 and 88,000 to realization account. Because we are transferring it from realization account, so that's why the name will come 1,32,000 and 88,000. Okay, then whatever is taken over by a partner or whatever is a liability paid by a partner, that also we have to take in partner's capital account. So here we have got Divya's account. Divya has paid the external partner's loan, that is 60,000. So 60,000 we are going to write over here by realization Divya. 60,000. Then again we have to check our realization account and we have to see what else is remaining. Ria's account, stock is taken over by a partner, 60,000. So to realization account, Ria, 60,000. Okay, what else is left? General reserve we took the balance brought down. Now we have to find out how much is the capital figures. Okay, so now 4 lakh plus 24,000, which comes to 4,24,000. Then 3 lakh plus 16,000 plus 60,000, which will come to 3,76,000. Okay, then so 4,24,000 is the heavier amount on credit side. 4,24,000 minus 1,32,000 minus 60,000, which comes to 2,32,000. Now this 2,32,000 is the balancing figure, and this figure we have to transfer it to bank account. Okay, so that's why I'm writing over here as to bank account. Then 3,76,000 minus 88, which comes to 2,88,000. And both the sides you have to write down properly. Okay, 3,76,000 on debit and credit side. Now from partners capital account we have to transfer it to bank account, right? So bank account, what we are going to transfer first is by Ria's capital account 2,32,000, and then by Divya's capital account 2,88,000. Okay, then what else is remaining? Realization expenses, no? So by realization expenses, 5,000. Then creditors by realization account 1,04,500. Okay, and the balance what we got is 70,000. So to realization account, how much the total we got from here? 5,59,500, that we have to take it on debit side. So to realization account, so the total of both the sides should match. 6,29,500, 6,29,500. Okay, then next question, section B. Return on shares is known as dividend. Then debenture holders are called as the creditors of a company. Comparative statement is also known as horizontal analysis, and common size statement is called as vertical analysis. These are the things you have to remember. Common size statement is known as vertical analysis. Okay, then if other incomes have increased from 8 lakh to 10 lakhs in the comparative statement of a company, then increase or decrease is what? Okay, so increase and decrease we have to find out in the comparative statement. So how we are going to do? we just have to do 8 lakh minus 10 lakh, which will give us 2 lakh divided by 8 lakh multiplied by 100, so which will give us 25%. So this is the correct answer. This 25% is correct answer. Increase from 8 lakh to 10 lakh. So we have to take 10 lakh first. Okay. Okay, so answer is 25%. Then, which of the following will be classified as financing activities in a cash flow statement? Financing activity, we take proceeds from borrowings and payment of dividend. Okay, so the third option is correct. Then, while calculating operating net profit in the cash flow statement, which of these items given below will be added to the net profit? Which will be added to the net profit is this: creation of general reserve. This is the correct answer. The next question is, Hazel Limited invited applications for 3000 equity shares of ₹100 each. So here we have to pass the necessary journal entries. Journal entries in the books of Hazel Limited. Okay, here you can write down either date or serial number. Okay, so now what is the question they have given is, Hazel Limited invited application for 3000 equity shares of ₹100 each. The amount payable on application was 25 per share. So on application they have given as 25 per share. This issue was fully subscribed and the shares were duly allotted. Past journal entries for the above transaction. So 3000 equity shares and only they have given as application. So how do we pass? Only the two entries we have to pass. So first one is that application amount is going into the bank. So bank account debit. So to equity share application account. So here they have given 3000 multiplied by 25. So bank account debit to equity share application account. Being application money received on, being application money received on 3000 equity shares at ₹25 per share. So 3000 multiplied by 25 will give us 75,000. Here also 75,000. Okay. Second is, you have to transfer this to the equity share capital account. So equity share application account debit, equity share application account to equity share capital account, equity share capital account, which will give you same 75,000. And narration you have to write down, being application money received on, being application money 3,000 equity shares at rupees 25 per share, at rupees 25 per share transferred to this account, equity share capital account, transferred to equity share capital account. Okay, then we'll move to the next question. State the heading under which the following items will be shown while preparing the statement of profit and loss of a company. So provident fund contribution is basically given for the employees, so it is going to go on employee benefit expense, employee benefit expense. Then depreciation on premises is depreciation and amortization expenses. Under this head it is going to go depreciation and amortization. Then bad debts is all the other expenses. Then loss on sale of machinery is also other expense. Okay, then next is from the following information given below, calculate revenue from operation. And how do we calculate revenue from operations? Revenue from operations include only sales. Okay, revenue from operations. So here they have given sales amount, then we have to minus excise duty and sales return. So excise duty is minus from sales and sales return is also minus from sales. So sales actual amount is 21 lakhs. Then sales return less sales return, that is 1 lakh. Then less excise duty, which is 28,000. So this comes to, let's total this and find out the answer. 21 lakhs minus 1 lakh minus 28,000, which comes to 19 lakh 72,000. Okay, so this is how you have to calculate revenue from operations. Then next, calculate the current ratio from the information given below. So current ratio is, in order to find out current ratio, what is the formula? Current asset divided by current liability. Current assets divided by current liability. So current asset, how much current asset they have given over here is your cash at bank, then debtors and stock. These are your current assets. So we just have to take all the things, that is cash at bank plus debtors plus stock divided by all your current liabilities. Now how many current liabilities are left? They have given it already as 3 lakhs. So current liability cash at bank 5 lakh plus debtors 1 lakh 60 and stock 40,000. Current liability 3 lakhs, so which comes to 7 lakhs, the current asset divided by your liability. So the answer is 2.33:1. So this is how you have to solve the ratios. Then next is Cipla Company Limited. Forfeited 2000 shares of rupees 50 each, issued at par for non-payment of first and final call money of rupees 15 per share, and these shares were reissued at rupees 45 per share. Then they have told us to pass the journal entries in the books of Cipla Limited. So I'll write down journal entries in the books of Cipla Limited. Journal entries in the books of Cipla Limited. Serial number, particulars, LF, debit and credit. So the question is about forfeiture. Yes. So when the question is regarding the forfeiture, then you have to debit share capital account. Okay, and how much it is? 2000 shares were forfeited of rupees 50 each. So share capital account, debit share capital account, debit. So 2000 multiplied by 50, which will give us 1 lakh. Okay, then next, rupees 50 each issued at a par for non-payment of first and final call money of rupees 15 per share. So first and final call money were not paid. So how we are going to put? There is a calls in arrears, no? Because they have not paid the amount. So 2 calls in arrears, that is 2000 multiplied by 15, which comes to 30,000. Then 2 share forfeiture account. This will be always your balancing figure. 2 share forfeiture account. So 1 lakh minus 30,000, which will give you 70,000. Okay, so the narration you have to write down as being 2000 shares forfeited, being 2000 shares forfeited for non-payment of first and final call money. At rupees 15 per share. Okay, then they have given that the second part, these shares were reissued at rupees 45 per share. So second one is these shares were reissued, yeah, at rupees 45. So again, when they are reissuing it, earlier the amount was 50,000 of each share. Now they are reissuing it at 45. So it means they have given discount. So since they are reissuing at rupees 45, rupees 40 on 45, you have to multiply that 2000 shares. So 2000 multiplied by 45, which will give you 2000 multiplied by 45, which will give you 90,000. Okay, so then share forfeiture account, debit to share capital account. Share forfeiture, how much do we have in share capital? We have 1 lakh. So here, if one transaction is getting debited, another will be credited. So 1 lakh. So 1 lakh minus 90,000, we are getting the balancing figure as 10,000. Okay, then the third, then the narration, being reissue of forfeited shares at rupees 45 per share, being reissue of forfeited shares at rupees 45 per share. Okay, then the third one. Now we have to check share forfeiture account, both the balance, that is debit and the credit balance. Now in debit balance we have got 70,000 and credit we have got 10,000. So how much is surplus that we have to transfer it to capital reserve account. So share forfeiture account debit to capital reserve account. Share forfeiture, how much is the difference we are getting now? So 70,000 minus 10,000 will get 60,000. We have to write down the narration. Being balance amount in share forfeiture account, being balance amount in share forfeiture account is transferred to capital reserve account. Okay. So this is how you have to solve the journal entries. Then next, Shanti Limited bought the business of Gracie Limited. This is with regards to business being getting purchased. So journal entries in the books of Shanti Limited. So since we are purchasing the business of Gracie Limited, Gracie Limited should always get credited. Okay. Consisting of sundry asset 11 lakh 20 and creditors 2 lakh. So sundry asset, how much amount they have given? 11 lakh 20. So this is first sundry asset. Eleven lakh 20,000. Then to creditors. Creditors, how much we have? 2 lakh. Okay. Then to Gracie account, because we are purchasing it from Gracie. So 11 lakh 20 minus 2 lakh, which will give us 9 lakh 20,000. And you have to write down being purchased asset and liabilities. Being purchased asset and liabilities of Gracie Limited. Okay. Okay, then the second one is 2 lakh was paid by check, so half of the amount is paid by check. Okay, and for the balance amount of the company issued 6% debentures of rupees 100 each at a premium of 20%. So the second one, since we paid Gracie by check, so Gracie Limited account debit to bank account. So how we'll get this? Being amount paid by check to Gracie Limited. So 9 lakh 20. Okay, how much we have paid? 2 lakh. Okay, then the third one. And for the balance amount of the company issued 6% debentures of 100 of rupees 100 each at a premium of 20%. So whenever the entry of premium is there, you have to take Gracie Limited account, then to 6% debenture account, to securities premium. So 9 lakh Gracie Limited, how here we have to find out how much is the amount of issued share. Okay, so 7 lakh 20 is what balance we have now, divided by 120. 100 is the face value plus 20 is the premium amount. So which comes to 6,000. Okay, so 6,000 were the number of debentures which were issued. Okay, so Gracie Limited 6,000 into, including the full value 120, so which comes to 7 lakh 20. Then 6% debenture 6,000 multiplied by 100, which is the face value, then 6 lakh. Securities premium is 6,000 multiplied by 20, which will give us 1 lakh 20,000. Then being issued 6,000, 6% debentures at a premium of 20% in settlement of purchase consideration. Okay, so this is how you have to solve this question. Then following is the profit and loss statement of Lifton Limited for the year ended 31st March 2017. Okay, so prepare the common size statement of Lifton Limited for the year ending 31st March 2017. So how we are going to prepare? Since they have given this in like revenue from operation 3 lakh, then other incomes. Okay, you have to find out how much is the percentage. Okay, so common size statement of Lifton Limited for the year ending 31st March 2017. So you have to prepare the columns, particulars, amount and percentage change. amount and how much is the percentage, and here particulars will come. So the first one is income, that is your revenue from operations. Yes, so revenue from operation, and then total. Other income is not given, so we'll skip this. We'll directly move to the total revenue. Okay, so income, then revenue from operations, revenue from operations. So revenue from operation, how much amount they have given? They have given it as 3 lakh. So 3 lakh, and now you have to find out how much is the percentage change. So now total revenue they have given as 3 lakh. So here the percentage change will be 3 lakh divided by 3 lakh multiplied by 100, which will give you 100%. Okay, then total revenue also will be the same, 3 lakh and 100%. Then the next what they have given is expenses. Cost of material consumed 1,50,000. Cost expenses, cost of material consumed. The second one, cost of material consumed is 50,000. So so 1,50,000, here it's 1,50,000. So 1,50,000 divided by 3 lakh multiplied by 100, which will give you 50%. So this is 50%. Then next what they have given is finance cost and other expenses. So I'll write finance cost, other expenses. Then total expenses what they have given, I'm writing it over here, total expenses. Then so finance cost amount is 20,000 and other expenses is 15,000. So 20,000 and 15,000. So 20,000 divided by 3 lakh multiplied by 100, which will give you 6.67%. So it's like 20,000 divided by 3 lakh multiplied by 100, which will give you this. Then 15,000 divided by the total amount. So 15,000 divided by 3 lakh multiplied by 100, which will give you 5%. So here 5%. Then we have to see the total expenses. So how much is the total expenses they have given over here is 1,85,000. So 1,85,000 so 1,85,000. So 1,85,000 divided by 3 lakh multiplied by 100, which will give you 61.67%. Then next is profit before tax, 1,15,000. Profit before tax 1,15,000. Then less provision for tax 28,000. Okay, and then profit after tax they have given as 87,000. So these also same, profit before tax 1,15,000 divided by 3 lakh multiplied by 100, 38.33. Then less income tax divided by 3 lakh multiplied by 100, 9.33. That is in negative figure. Then 87 divided by 3 lakh multiplied by 100, 29%. Okay, so this is how you have to find out the common size statement of Lifton Limited. Then question number 21, calculate the proprietary ratio from the following. Okay, and also they have told us to calculate return on investment, okay, from the following information. So proprietary ratio, the formula for proprietary ratio is shareholders fund divided by total assets. So first we have to check how much is the shareholders fund. So shareholders fund, here they have given only one, that is share capital. So 26 lakh 265 divided by, how many total assets do we have over here? We have tangible asset, then short term investment, and cash and cash equivalent. So all the three amounts we have to total it together. So plus 325 plus 7 lakhs. So which comes to divided by 2925 plus 0. So which come to 0.91. Okay, so this is your proprietary ratio. Then calculate return on investment from the following information. Return on investment is, the formula to calculate return on investment, return on investment is equal to profit before interest and dividend, profit before interest, tax, and dividend divided by capital employed. So return on investment formula is this: profit before interest, tax, and dividend divided by capital employed. So here we have to find out how much is the profit before interest, tax, and dividend. So it is already given as 1,88,000. Okay, then we have to find out how much is the capital employed. Capital employed means how much is the capital which is contributed in the particular organization. So here you have to take your current asset and liabilities. Okay, so your assets, land and building, then short term investment, and liabilities you have to check, liabilities you have to minus. So 1,88,000 is our profit before interest, tax, and dividend. So 1,88,000. Then we have to take our capital employed, land and building 6,50,000 plus your short term investment, current assets, minus your creditors 1,20,000, okay, multiplied by 100, so which gives us 1,88,000 divided by 8,30,000, which gives us 22.65%. Okay, so this is how you have to find out return on investment. Then next, the following ledger balances are extracted from the books of Caron Limited as on 31st March 2017, and here you have to prepare balance sheet of Caron Limited. So balance sheet of Caron Limited as on 31st March 2017. Okay, particulars, note number and amount. This is how we have to prepare the balance sheet. The first thing is we have to classify. Machinery is your tangible asset. Investment for 1 year is your current investment. Premises is your tangible. Computer software is your intangible. Debtors is your 2,80,000, right? Debtors. So it's trade receivables. Discount on issue of share, other current assets, other non-current assets. Stores and spares is inventory. Interest accrued on investment is other current asset. Cash at bank will come in cash and cash equivalents. Okay. Then general reserve is your reserves and surplus. Creditors is your trade payables. Cash credit 90,000 is your short term borrowings. Short term borrowings. Then mortgage loan, long term borrowings. Long term borrowings. Then 12% preference share capital will go in share capital. Equity share capital, also share capital. Staff welfare fund is your long term provisions. Long term provisions. Then provision for taxation. Provision for taxation is your short term provision. Short term provisions. Okay, so now we have to classify and we have to find out is there any working notes are there or not. So working a note is there for our tangible asset, machinery and premises. So I'll prepare working note first. So working note number 1, tangible asset. First one is machinery and we got premises. So machinery is 6 lakh and premises is 30 lakhs. Premises 30 lakhs. Okay, so the total of both the things comes to 36 lakhs. Okay, so this working note number 1, we have to show it over here as a tangible asset and we got 36 lakhs. Okay, then the second one, we have to start from the first share capital. How much we got? We got equity share capital here and preference share capital. So equity and preference share, both the amount you should not match. You should take the amount separately of both. So I am writing over here as first equity share capital, equity, and second I am writing as preference. Okay, so equity we have equity 25 lakhs, and here preference shares we have 8 lakhs. Then reserve and surplus. Is there any reserves and surplus? Reserves and surplus, yes. For that is for 6,35,000. 6,35,000. Then money received against share warrant, no. Then this is no. Then non-current liability. Is there any non-current liability? We have long-term borrowings, and long-term borrowings under this we have mortgage loan 5,70,000. Then this is deferred tax liability. This is not to be evaluated. Then we have long-term provisions. Long-term provisions are only staff welfare fund, that is for 1,20,000. Then current liabilities we have to check. Is there any short-term borrowings? Cash credit 90,000. So cash credit 90,000. Trade payables creditors, which is for 1,85,000. Then other current liabilities are there? No. Then short-term provisions, provision for tax, that is 48,000. Then the total of both the side comes to 4,94,800. Sorry, the total of both the side comes to 49,48,000. Okay. Then we have to check the asset part. Any asset is that we took the machinery and premises. Now we have to check for investment for 1 year, that is current investment 4,70,000. So it will go in current investment, that is 4,70,000. Then next is inventories. Any other inventories are there? Okay, we'll check this first. Tangible we took. Intangible, any intangible asset 72,500. Computer software 72,500. Then other non-current assets. Other non-current assets are discount on issue of shares 68,000. Then current investment 4,70,000. Inventories we have to check. How many inventories are there? Inventories we got stores and spares 3,35,500. 3,35,500. Then trade receivables. Is there any trade receivables we have got? Debtors 2,80,000. Then cash and cash equivalents. Cash and cash equivalent is 82,000. And then other current asset, interest accrued on investment, other current asset, which is of 40,000. So total of both the sides should match, that is 49,48,000. Okay, so this is how we have to prepare balance sheet. Okay, then we'll move to the next question. You are given the following information. This is your cash flow statement, wherein you have to prepare land and building account and proposed dividend account. Okay, so the first step is you have to prepare land and building account. So I'll show land and building account over here. So land and building account, this is the normal asset account. So particulars amount. So the first thing is you have to check how much is the opening balance and the closing balance of land and building. So opening balance is 2,90,000 and 3,78,000. So two balance brought down, 2,90,000, by balance closed down, 3,78,000. Then what else they have given is depreciation of 20,000 has been charged on land and building. So by depreciation, $20,000. Only this information we have, so we have to total both the sides. 3,78,000 plus 20,000, which comes to 3,98,000. Then here 3,98,000 minus 2,90,000, which comes to 1,08,000. So here we are getting the balancing figure. So it means they have purchased. On debit side we are getting the balancing figure. So it means they have purchased an asset, 3,98,000. Okay. Then next we have to prepare proposed dividend account during the year 30,000. During the year is 30,000. So I am preparing proposed dividend account also. Proposed dividend account. So particulars, amount, particulars, amount. So now here we have to check, since this is the proposed dividend account and not a normal asset account, we have to take the opening balance on credit side and the closing balance on debit side. Okay, now proposed dividend account 42,000 and 50,000. So 42,000 we are going to take on credit side as by balance brought down, 42,000, and to balance carried down as 50,000. Then they have given us that proposed dividend during the year is 30,000. So during the year it is 30,000. It means they have given a provision. So by profit and loss account is 30,000. Okay, and so the total of this side is 72,000. Now here if we are getting proposed dividend, that here we'll get the balancing figure, which is 22,000. Okay, now cash flow statement of okay, they have not given any name. Balance sheet of Chester Limited, but cash flow statement of Chester Limited for the year ending 31st March 2017. So cash flow statement of Chester Limited for the year ending 31st March 2017. So the first step what we have to see is this cash flow from operating activity. Then here we have to check the profit and loss amount, net profit of the current year, how much they have given, 70,000 and 1,18,000. So you have to minus both the things, so which will get 48,000. Okay, then we have to check We got a proposed dividend now. Proposed dividend for the current year they have given in the adjustment as 30,000. So this 30,000 we have to take. Then the total of both the things is, any other information we don't have, so we'll directly add net profit before tax and extraordinary item is 78,000. Then adjustment for non-cash and non-operating item is very important. So depreciation on fixed asset, depreciation on land and building is there, which is of how much? Here we told we got 20,000. So depreciation is of 20,000. Then we have to check whether any amortization of intangible asset is there or not. So now see, the value of goodwill 1,15,000, and for the current year it is 90,000. So it means they have purchased goodwill. So since they have purchased goodwill, we'll get the difference. We first have to find out the difference. 1,15,000 minus 90,000, which will give us 25,000. So 25,000 is amortization of intangible asset, goodwill. So the value is decreasing during the current year. So it means we have to amortize that particular intangible asset. Then any other non-current asset is not, they have not given. So we have to find out how much is the operating profit before working capital changes, and it comes to 1,23,000. Then we have to see whether any current asset or current liabilities are there. So creditors, current liability, current asset. Then this is tangible, this is intangible. Okay. So in what is happening to the creditors? Is it increasing or decreasing? So 55. So it is increasing. So increase in current liability, you are going to add creditors. Increase in current liability, creditors only we have, and it is increased by 28,000. Then we got increase in current asset, debtors. How much they are increasing? 82,000, but we have to minus it because current asset, increase in current asset we minus. Then cash generated from operations we have to find out, that is 69,000. Income tax paid, anything is there? No. Then move to the next. So this is the cash generated from operation, we got 69. So net cash from or used in operating activity is 69,000. Then next, cash flow from investing activity, we got purchase of land and building. So how much is the balancing figure we got? 1,08,000. So 1,08,000 we have to minus. $1,08,000 will come over here because we have purchased the land and building. Okay. By 1,08,000. So net cash from or used in investing activities 1,08,000. They have not mentioned any other thing. Then we have to check cash flow from financing activity. Equity share is there, which goes in financing activity. So it is increasing. It is increasing by how much? That we have to find out. So earlier amount is 5,10,000 and now it is 5,66,000. So it means it is increasing. It means proceeds from issue of equity and preference shares. We should only take the equity shares over here because only equity share is given by 56,000. Then any other thing is there? Dividend paid. Dividend paid we got this amount. This is the 22,000. Whatever the balancing figure we got, that is dividend paid. Final dividend paid is 22,000. So 56 minus 22,000, we are getting 34,000. Then next, net increase or decrease in cash and cash equivalent. This 34,000 plus minus 1,08,000 plus 69,000. will give us 5,000. Okay, and then we have to check cash and cash equivalent at the beginning. So at the beginning it is 15,000 and at the end it is 10,000, which will give us 5,000. Okay, so this is how you have to check, and this is how we prepare the cash flow from cash flow statement, okay, of operating activity, investing activity, and then the financing activity, which is very important. Okay, and then you have to put cash and cash equivalent in the beginning and cash and cash equivalent at the end of the year. Okay, so land and building account, like this you have to prepare the asset account, and proposed dividend account you have to show. Okay, thank you for watching my video.